Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals, celebrating our 25th year in business this year. It's Friday afternoon, March 21st, and it's all about the Fed this week, as it was Whirlybird Janet's first FOMC meeting on Wednesday. And oh yeah, the Ukraine, which the MSM says is de-escalating, when in fact Crimea has been annexed, Russian troops have been increased in the area, shots have been fired, and the level of East versus West rhetoric and sanctions has increased dramatically. In fact, Merkel today said that the G8 is officially no more because they're not recognizing Russia. Clearly, Crimea is lost permanently to the Russians, and the only question is whether Obama backs up his tough talk with suicidal action or simply shuts up and allows history to play itself out, as he should. After all, this was a democratically elected referendum in Crimea, and the people want out. I mean, what's the big deal? They're Russians, they want out. And look, the Ukraine is falling apart as an economy because of all the money printing that's gone on in the West. So I don't blame these people for wanting to leave a collapsing nation and going to a stronger one. Anyways, last week ended, equity markets were in turmoil. Fear of the Ukrainian crisis and ongoing plunges in global economic data were the buzz. With the Chinese real estate, finance, and construction bubble starting to collapse, as the shadow banking bankruptcies multiplied and copper prices plunged to multi-year lows, and the PBOC widened the yuan's daily trading range to allow it to sharply decline, which it has. Even the PPT-supported Dow Jones Propaganda Average was starting to fall. Couple that with precious metal prices hitting new highs for the year, amidst blistering physical demand, particularly in the silver market, where the U.S. Mint continues to ration silver eagles. And oh, by the way, Chinese imports from Hong Kong of gold were, I think, in January their highest ever. And obviously, the powers that be were quite scared of things were going. So the last thing they needed was a plunging Dow and surging precious metal prices, or as I call, a violation of cartel rule number one, with the FOMC meeting on Wednesday. So they went into action Sunday night, starting with the 29th Sunday night sentiment attack in the past 30 weekends, which basically means as soon as the markets open at the very illiquid Sunday night hour of 6 p.m. Eastern Standard Time, just when the Asian markets are waking up, either gold gets hit or it goes up and then is immediately capped with a cartel herald algorithm and taken down, which is exactly what happened. In fact, gold got to 1397 in the opening hour of trading before they attacked it. Care of the PPT, stocks were bulled up on Monday and Tuesday amidst the aforementioned litany of bad news, while precious metals were viciously attacked morning, noon, and night. Remember, the markets are supposedly terrified of tapering, and thus, given the universal expectation of further tapering Wednesday, watching the Dow surge 270 points Monday and Tuesday was just plain ridiculous. In fact, the PPT went into particular action when US and European markets were deeply red Tuesday morning when Putin gave a speech. The speech was decidedly antagonistic. In fact, I think it's an historic anti-West speech. But the MSM was all over the airwaves with their second, quote, softening stance headline barrage of the past 2 weeks. And anytime the Dow rises, amazingly, European stocks do too, care of the algorithms programmed to drag them up in perfect synchronicity. Gold, of course, was tacked anew, and when just hours later shots were fired between Ukrainian and Russian troops, somehow gold didn't recover and the Dow didn't fall. Actually, it did recover until the cartel capped the gains and attacked further on in the day, as they have all week. Frankly, even I, in 12 years, haven't seen such a concentrated barrage of naked shorting. Outside of last year's alternative currency destruction attacks in April, and maybe even what we saw in September of 2011 and May 2011 when gold and silver hit their all-time highs. In all these cases, the similarity is that you had a terrified cartel, and the fact that they were just as terrified now at much lower prices in gold and silver as they were at record prices shows you just how difficult they see the coming months being. But don't worry, gold and silver holders, at today's depressed prices, they are both well below the respected costs of productions, causing earnings, production, and capex to plunge, while 2014 has started out with an even stronger pace of global physical demand than 2013's record-shattering levels. Thus, the downside is extremely limited just from a commodity standpoint, no matter how much they try. And in particular, I think the cartel is terrified of the both metals on the verge of what's called a golden cross in technical terms. Now, again, uh, I'm not I'm not a big technical analysis proponent in these rig markets, but a lot of, as they say, black box traders look at these, and that means when the 50-day moving average closes above the 200-day moving average, it's seen as very bullish. Both metals have been, the 50's been below the 200 since those attacks a year ago. And now I think gold will probably make that golden cross in the next few days, and silver is going to be probably right behind it by a week or two. So this is a very interesting scenario. Again, I'm more into long-term technical analysis in a rig market, but 200-day moving average, that is reasonably long-term in this short-term world, and there'll be a lot of people watching it. So keep your eyes on it. Now, when Janet Yellen spoke, of course, on Wednesday afternoon, which was just a complete comedy of propaganda, they attacked precious metals further, of course, even though she said nothing incrementally hawkish. Yeah, they did their supposed tapering, which I've talked about before, but they got rid of the 6.5% unemployment rate threshold for ending zero interest rates, meaning they have no guideposts anymore to what would make them change their policy. They also lowered their GDP estimates, and she insisted that rates would stay at zero for at least 6 months after QE ends. That is, if it ends. I mean, frankly, she took Fed speak, as created by Alan Greenspan, to a new level of idiocy, speaking in vague platitudes at a level even Bernanke wouldn't go to. Comically, she spoke of recent improvement in the labor participation rate as a positive. I mean, what happened to the... sorry, I was changing the page. Where are the 1.3 million people that lost their long-term unemployment benefits in December? How come they haven't been taken out of the labor force, which would have made it plummet? Not to mention the portion of the 3.4 million people who are scheduled to lose their long-term unemployment benefits this year. And by the way, with the improvement she's talking about, a year ago we were at 64% in the labor participation rate. It fell to 62.5% in December or January, and then just ticked up to 62.7. So that's what she's referring to. Again, ignoring those people, which the BLS refuses to take out of the labor force, because clearly they didn't want the unemployment rate to fall below 6.5% and make the Fed look even more stupid. And of course, the highlight of her speech was when she said that the Fed, in its last meeting back in January, overdid the optimism, whatever that means. Okay, so in other words, it was a complete zero of a FOMC statement and a zero of a press conference. They may have said they're tapering another 10 million a month, but if so, they're still printing 55 billion a month, and likely far more. Per my recent piece, Proof of the Tapering Mirage, I estimate that they were spending more like 130 billion a month between May and December of last year than the 85 billion they were saying. And given that China, the largest non-Fed treasury holder in the world, sold 49 billion of treasuries in December alone, and per data released this week, foreigners as a whole sold a record 104 billion just last week. I think it's pretty clear that the Fed has been, as I say, QEing far more than it says in 2014 than they purport, whether they're tapering or not. I mean, tell me how the 10-year yield could have fallen from 3%, and I wrote that piece, 3% enough said, meaning that's their line in the sand, 3% down to 2.65% in the first place with all of this foreign selling. Yes, the Fed has been buying much more than they say, which is no surprise given all their other lies. like the 16 trillion of secret loans they gave out between 2008 and 2010, the Fed swap agreement with European banks between 2008 and 2013, which basically means they print money and give it to the banks, but they call it swaps, so they don't have to consider it money printed. Um, Not to mention the lies of the other U.S. government supported manipulation entities like the President's Working Group on Financial Markets, or as they are called, the PPT, the Exchange Stabilization Fund, whose mandate is to manage foreign exchange and gold, and of course the Bank of International Settlements, who is, in my mind, as the central bank, the ringleader of how the gold is suppressed. And then, of course, the so-called regulatory bodies like the CFTC and the SEC, which don't regulate, and laws like Dodd-Frank, which don't impede banks from crimes in the slightest. Heck, in the past 2 months, the Treasury claims that Belgium, the country of Belgium, has purchased more than 100 billion of treasuries, which would be offsetting the sales of the Chinese. Now that makes Belgium the fourth largest non-Fed holder of treasuries. That's amazing because 100 billion, it was actually more than 100 billion, is about the amount of their entire annual GDP, which by the way is less than, as Bill Holter put it, less than 35 US states. So let's see, the EU, which is based in Brussels, all of a sudden Belgium is a big owner of treasury bonds just when we need them. I wonder if the ECB had anything to do with it. Just like the Caribbean banking centers before them, which a few years ago came out of nowhere to start buying hundreds of billions of dollars of treasuries when we needed them. In other words, the whole tapering farce is just a sideshow. Really, it comes down to confidence, which is rapidly flagging worldwide, care of the massive inflation exported, I should say, over the past 5 years by the Fed and other major central banks. That's why the Fed needs to buy as many treasury bonds as possible to keep confidence in the United States, and of course to keep rates down because of the massive debt that they and the institutions and individuals in America have. Not to mention that half of the world's interest rates are tied to the U.S. Treasury rates. I mean, this is why we're seeing currency crashes and social unrest everywhere, from Thailand to Argentina, Venezuela, Turkey, Kazakhstan, Brazil, and of course the Ukraine. And why the worse things get, the more vicious the loop of new money printing becomes. Comically, Western central banks are speaking more vehemently than ever of deflation, as I wrote in my Wednesday's piece called Deflation and Recovery, with both in quotes. Japan, for example, has been among the world's most expensive countries throughout its 25-year depression. And yet its CPI just had its biggest jump in years. In Europe, gasoline prices are stubbornly around $9 a gallon. And in the United States, gasoline prices are surging, particularly at this time of the year. You know, it's not the driving season yet. And as I wrote in my piece the other day and put in graphs, milk, beef, and chicken prices all rocketed higher this year to record levels. In fact, beef rose 4% last month. That's the biggest monthly increase in beef prices in 10 years. I think, and milk is up 24% this year alone, as in since January. And I actually just saw a piece was sent over to me, a study that shows that non-Obamacare health plans have seen a roughly 50% premium increase already. But the CPI says that we're on the verge of deflation. Again, I can't emphasize enough, and forget the CPI and the core CPI and all the things they do to it. Things that we, as I called it, need versus want. I've written 2 pieces on it. Go up in price during fiat currency regimes. So you name it, anything that you need to live on, and the price is higher. But things you want, which by the way includes houses, you don't need to own a house, you just need to rent one to live, go down in price. And that's what you're going to continue to see, save hyperinflation, in which case everything soars in price. Of course, they don't soar in real terms. Now, as for the economic data this week, amidst the so-called recovery, there really wasn't much going on overseas, but there's always something here as this nation now leads the world in economic data releases. It's incredible. I mean, there's got to be 10 or 15 of them a week, and all these private agencies putting them out now. Half of them, which we learned, have been selling that data to high frequency trading companies beforehand so they could trade on it. Well, anyway, the biggest news of the week was Monday when the NAHB Housing Market Index came out. Again, NAHB, it's National Association of Home Builders. This is a trade organization. This is not the government. These are eternal cheerleaders. There's no one who will lie more. I mean, they a few years back they were forced to change all of their data numbers. They said, "Oh, sorry, we overestimated demand for several years." So, I mean, these are not good people. And last month, if you recall, their index fell from 56 to 46. I mean, a catastrophic drop for 1 month. And of course, people say, oh, it's the weather. So this month, people were expecting a big increase. And all it did was just go up 1 point to 47. Wednesday, another 1% drop in mortgage applications to a new 19-year low. Thursday, this Philly Fed index, I am just so sick of watching it. It's such a joke. This survey, it goes up, it goes down. This time it went up to 9 from -6 last month. Not that 9 is a good number, it's a very low number. But the employment index fell to a 9-month low. So what does that tell you about that index? New home sales came out on Thursday, the lowest level in 9 months, including an 18% drop in the low end of the market. That's where all this Fed finance money came, where all the Wall Street, the Blackstones came in to buy the depressed houses. Now that business is falling off in a big way. And then, of course, care of the Fed's moronic tapering announcement on Wednesday, the 10-year Treasury yield rocketed up from 2.7 to nearly 2.8 on Wednesday, putting it again in that 3% range. That line in the sand. What will that do to housing demand, particularly in the most indebted nation on earth? Or for that matter, the entire world, which just passed 100 trillion of total debt this week. Not including, of course, off-balance sheet items and unfunded liabilities, which are multiples of that amount. And oh yeah, those derivatives, which we no longer are told how much they are. Again, 3%, enough said. You know, if rates continue to rise toward 3%, get ready for some even worse economic data because the Fed will just as easily manipulate for instance, the NFP report for March. They'll manipulate it to make it look bad so that they can get some aid by the retarded market people who just, you know, on instinct will buy treasury bonds on bad economic data. That's what they do. Well, anyway, it's Friday afternoon. Copper prices sitting near multi-year lows. Most emerging market currencies down for the week, some of them very sharply. The Shanghai Exchange barely closed above 2,000, and in my view, the unraveling of the monstrous $20+ trillion Chinese real estate and construction bubble may well be the most catastrophic economic event of our lifetimes. Potentially with even more profound effects than the 2008 financial crisis, which I believe is just starting. And again, watch that 10-year Treasury yield, because the higher it goes, the more the global economy will be crushed, and the closer the fiat currency regime will be toward its inevitable demise. Well, as for precious metals, big deal. They were hit for a few percent this week. Care of the aforementioned insanely blatant cartel machinations. And amazingly, for the fourth straight week, COMEX registered inventories haven't budged from the piddling 637,000 ounce level. And that's despite close to 500,000 ounces still standing for delivery of the December, January, and February contracts, not to mention the big April gold contract is scheduled to expire on Wednesday. Of course, the biggest gold news of the week was completely ignored by the mainstream media, per the article I just wrote today. In other words, the Indian government, as I expected, as we've been talking about here at the blog, is starting to loosen up the ridiculous import restrictions it put on gold last year and silver. Well, right now they're just letting banks that were prohibited from importing gold import it, but soon they'll get rid of those tariffs that went from 2% to 10% last year. I mean, the budget deficit has barely budged lower, but they're saying that the reason that it's gone lower is because of the lower gold and silver buying, which is absolutely ridiculous. And in fact, demand, if anything, for gold and silver was higher. I was shocked when I saw that the gold imports for India were actually barely changed from the record levels last year. And of course, silver demand, even with 10% duties, shattered the 2008 record by 20%. So what's going to happen now when clearly this Congress party that's in charge, they're going to get voted out. They already lost the regional elections in December. They're going to lose the prime minister election in May. And when they do, they'll probably get rid of these ridiculous tariffs altogether. And therefore, the black market activity will slow down, the premiums will go down, and therefore supply will come into the market and demand will soar. So think about what's going to happen to physical demand now. Now, of course, these, when they come in and they hit gold and silver this week, all I could say is big deal if you're holding physical. I mean, if it's your savings, it doesn't change. I mean, frankly, you're given a gift from the heavens, given all that's going on, because you can get more if you wanted to. I mean, it's a once in a lifetime opportunity of record demand here, and the government is so terrified of what's going on that they are basically subsidizing prices at below the cost of production. All you have to do is look at the incredible, incredible losses miners made last year, the 50% drops in capex planned for this year. Many of the major miners are expecting between 5 and 20% drops in production this year. I mean, this is what happens. So you're going to see falling supply. In fact, I put it in my piece yesterday. I was shocked to see just how much U.S. production has fallen. U.S. production is down about a third in the past decade, and silver production in the U.S. is down about a half. Anyway, hopefully you will realize this rare once-in-a-lifetime opportunity to protect yourself. And if so, please give us a call at Miles Franklin at 800-822-8080. We'll be happy to answer your questions with no pressure, just good service. That's why we've been around for 25 years. Well, thanks and have a great weekend.